Hello, everyone. Welcome to our latest Kolleno webinar series, A World in Transition, Navigating Rising Costs, Interest Rates, and Energy Prices in Times of Uncertainty. On behalf of the team at Kolleno, really excited to have all of you join us and really excited to have Richard Diaz as well provide his perspective today. So maybe to kickstart, just so that everyone has, a bit of context in terms of, the speakers. I myself, my name is Gibran Larabier. I'm Chief of Staff at Kolleno, and I will be moderating today's event. I'm also joined by Kolleno CEO Dimitri Raziev. And so maybe here, Dimitri, I'll hand it over to you just to do a little bit of an introduction and talk a little bit about the webinar series and Kolleno itself.
Excellent, Gibran. Thank you very much. I'm myself ended up in London a couple of years ago. Did a graduate school, had an opportunity to work in investment banking, and decided to adventure myself into building a company. So we started Kolleno. It's a cash acceleration tool for the CFO office. Ultimately, it's a software that provides a cash management tool for the credit controller and to make strategic decisions for the CFO. In a nutshell, the platform itself, it's basically provides control, compliance, visibility, and performance, and helping companies across the world. We have clients in South Africa, in Canada, and in continental Europe. Just to name a few of the clients, for instance, the WeWork of Italy, we're operating and helping them with treasury management and cash flow management when it comes to late payments in three different countries, and 21st century to receive payments faster. This is a quick summary, Gibran.
Yeah, perfect. And I think, to that, I think a key element of why we wanted to also, launch the webinar series and why we're moving forward with these discussions is, we have the opportunity to work with a number of CFOs and business leaders, and a number of the topics that we'll be discussing today, of course, are going to be top of mind for that audience. So really excited to be launching this. And, with that, we'll jump right into the agenda. And also want to take the opportunity to welcome and thank Richard Diaz for taking time to join us today. And so, in terms of agenda, we'll be going through and doing, Richard will be walking us through a bit of an overview of the current economic landscape, providing his perspectives on that. And then, we'll be talking a little bit about the economic and financial impacts for business leaders and how businesses and investors can position themselves as they look forward. So maybe, Richard, here, I'll hand it over to you just to provide an introduction. And thank you again for providing us with your perspective today.
Sure. Thank you so much for having me. Introduction, where do I start? I'm also from Montreal. Met Dimitri many moons ago and several lives in the landscape from a top-down perspective. Now I've pivoted a little bit, started my own firm to sort of be more independent, be more forthright, and sort of struck out on my own in order to sort of share my views with institutional investors all over the world. I help high net worth individuals as well as institutions. And I also provide sort of a retail product for people who who just want to get started and are keen to learn more. As you'll tell from my presentation, I'm really quite passionate about what I do, and hopefully I can help you guys navigate these choppy waters.
Excellent.
Perfect. Thank you, Richard, and thank you, everyone. So with that, Richard, I'll hand it over to you to take us through some of your thoughts and perspectives in these times.
Sure. Okay, great. So I was always taught to not read my slides, and so I won't do that today. But I think it's important that anyone who has a minute, again, I've been told that you'll be able to get this presentation afterwards. And so I won't stay too long on this chart, but slide. But it's important, sort of, just as a starting point, to set the framework for the rest of the chat, to sort of lay out where we are. And global growth is slowing again. So that's the first important point to note. There are different reasons why this might be true. In Europe, it's boneheaded in energy policy, and in China, it's an obsession with zero COVID. On both counts, they're wrong, and eventually, they will pivot. I'm confident in this because, to quote Winston Churchill, you do all the right things, and eventually you'll find the right answer. And it's important that we notice that the U.S. right now is the only cylinder for growth, only cylinder in the global growth engine, but that's precarious as well, as we have the Federal Reserve, which is the central bank of the United States, raising interest rates, the Federal Reserve Fed funds target rate, in order to combat inflation. Now, it's not clear necessarily that that's going to help or work, but that is exactly what's happening. And it's important that investors understand sort of that sort of broad-based setup. As a function of those sort of three, silos of three and environmental dogma that have led to underinvestment in critical infrastructure and will keep commodity prices high. So it's not exactly a sunny outlook at the moment, but that doesn't mean there aren't opportunities, especially for clients and colleagues of Kolleno, who are sort of perfectly placed to sort of take advantage of that kind of those kind of risks. And it's important, I think, it's what you don't know that can hurt you. And I think this is a chat that hopefully we can set up and lay out sort of the risks, and so that you and your teams can assess sort of opportunities. So let's kick it right off. I like to start my chats with sort of, and I didn't like laying out where we are. You can't get where you're going unless you know where you are. And so the way I like to do that normally is to sort of just do a simple year-to-date return chart. In this chart, I know there's a lot going on here, so forgive me, but in this chart, you sort of had all the sectors. You've got currencies, you've got regional equity market returns. And in one chart, it can sort of tell you what's going on in the whole year. Now, this chart, keen observers will note that this chart is not up to date. You'll have to forgive me for that. That's just that's just the slings and arrows of doing a webinar. But on the whole, I think it hasn't really changed in the last 8 trading days. And so you'll forgive us for that. But at the top left-hand side of the chart, you'll see the dollar commodity space is up and every other asset class is down. Bond, stocks, high yield credit. And that's basically the story of the year. There are reasons for why that's happening and the reasons, in my view, why it will continue. But that's just sort of the setup where we are. On the top right-hand side, you have a couple of, you have the regional equity performances. Again, we have the usual suspects, or one that what we can expect. Germany, which is suffering through sort of short-sighted and frankly rather ignorant climate policy and energy policy, suffering the most as far as equity market performance. And China sort of following suit as they insist on this COVID zero policy. So you can see this chart really sort of tells you the picture of what's going on in the world in just one, it's one quick shot. We've also got the global sectors and styles. And again, you can see the rotation away from the tech space as interest rates rise, and we'll get to that in a second. And then the only sector that's basically in positive territory, which is energy, followed by utilities, which is normally a sort of a quote unquote safe sector. Anyway, so that's sort of where we are as far as the year is concerned. And so we can talk about why that might be happening, and then again what's going to happen going forward. So this is the chart as far as why this might be happening. So markets at the mercy of real interest rates. So what we've seen over the last, I'd say, 18 to 24 months is an increase in real interest rates that have basically taken the valuation out of the equity market. So on the left-hand side and on the right-hand side of these charts, you'll notice that there's something that looks quite similar, and there it's not an accident. I put them like that on purpose. On the left-hand side, you have the valuation chart. So that's the global forward price earnings ratio. I imagine much of this audience is familiar with that concept. So I won't belabor that point. But on the right-hand side, you have the global equity market, and that's that blue line. And I mean, effectively, it tells you that whole story, the valuation of the equity market, is dictated and determined by real interest rates. And that sort of makes a lot of sense when you think about what's happening on the following chart, which is the sort of this is a truism. It's an identity, let's say, in financial market terms, that you learn sort of in finance class, in the first year of finance class I did with Dimitri. And what it shows you is that with no earnings, the price of the particular index is determined by the valuation. So what the market is willing to bear in the terms of price per that earnings. And as you can see quite clearly in this chart, we know that the gray line up here means earnings are flat. And so it's determined, the price of the equity market, the equity index, is determined simply by the valuation or the multiple that investors are willing to put on that earnings stream. The reason those two charts are really important is because if we think about what it means to lower the interest rate. So if you have a really low interest rate, your investors are willing to bear a much higher valuation. Some of you might be familiar with this concept when you think of an MCAP game in the real estate sector. Depending on your net operating income, if you have a very low interest rate, you're willing to pay much more, a higher multiple for that net operating income. The same is true in financial markets, and we can see that clearly here. As real interest rates, so as the cost of money, in theoretical standpoint, has increased, the more difficult it is to justify the valuations that we've seen on the equity index and some certain sectors, especially when, I reiterate, that the earnings per share growth has been zero. On the following chart, we have the earnings outlook. So again, not great. So in this chart, we have the EPS growth, so earnings per share growth, trailing over year on year. And then we have the South Korean market. Now, why did I choose the South Korean market? South Korea is a particularly, I'd say unique economy in the sense that it's extremely tied to Asia. It has refineries, they build ships, they build semiconductors, that has a robust auto sector. It's a rich and connected and globalized economy that's extremely sensitive to interest rate policy, to trade, leading earnings per share growth. Now, I'm not a fan of models, and I usually tend to stay away from them. And so, these kinds of charts you must assess with a grain of salt. But just as a sort of something that as we go on our journey to try to figure out what's going on in the world, it's an important sort of indicator to see, indeed, the earnings outlook is worsening. Why might the earnings outlook be worsening? Well, we talked about, interest rate policy in the United States. We talked about China's obsession with COVID zero. We've talked about Germany's naive and energy policy. Another reason is that consumers are not happy. So this chart's hopefully relatively straightforward. It's a consumer confidence index. For people who may not be familiar with this kind of index and the ones that are going to come up in the next slide, different non-governmental and quasi-governmental organizations will do surveys. They'll ask, thousands, I don't know if not tens of thousands of consumers and businesses, CFOs in some cases, CEOs in other cases, how they're feeling. Do they think inflation's going up? Do they think inflation's going down? Are they confident about their job prospects, their wage prospects, et cetera, et cetera? And we can see in this chart that consumers are not happy. There's another, the next slide is a similar situation. We have business confidence indicators. So again, just to reiterate, there are companies like the IFO, there's the DG ECFIN out of Europe, there's the MBS out of China. In Canada, we have the Ivy School, which is a university that asks businesses questions, and they aggregate and collate and present and publish these indices in such a way that people like me can look at them over time and compare them across country, across sector. And this chart sort of is indicative. I tried to sort of include as many countries as we could, and in such a way that the chart was still readable. But we have a global composite purchasing managers index, which is again sort of an indication or indicator of confidence, sentiment, as far and what businesses think is going to happen in the near future. Now, like consumer confidence indicators and models, these are not perfect, but again, it gives us another crumb, sort of another piece of the puzzle, as far as trying to figure out what's going to happen. And again, I think across the board, maybe with the exception of the U.S. services sector, which is big and should not be ignored, but by and large, you have the largest economy in the world on a purchasing power parity basis, China. We talked about South Korea and how useful that is as an indicator. All of these indicators, U.S. manufacturing and, of course, Euro area sentiment, dragged down by the German industrial base, all contracting and deteriorating. And so, why might the earnings outlook be falling, and why are the equity markets at the mercy of interest rates? So these are some of the. Yeah, I don't think we're there yet. I think that, the first slide or the first or second slide of my presentation, I said, don't fight the Fed. And the Federal Reserve is really the global central bank, like it or lump it. The US dollar is the global reserve currency until somebody comes up and proposes and or forces a different option. And the reason I bring that up is because, although a lot of the business confidence has deteriorated, I think that, there isn't necessarily been that much pain. If you look at employment, whether it's in Europe or in even in the UK or in the US, there hasn't been that much pain. And what I mean by pain, I mean unemployment has not gone up. Layoffs or claims, insurance claims for employment have not gone up yet. Wage growth still relatively strong. And so although that there's, these business climate indicators are deteriorating, whether or not we see the bottom, I think is determined on whether or not the Federal Reserve will continue to put pressure on interest rates, and whether or not we see some, decline in the labor market. And until one, the Federal Reserve stops, increasing real interest rates, and two, we have some sort of real pain in the labor market that sort of forces central banks to slow their current policy and or pivot to much easier monetary policy, I think that we'll see business conditions continue to fall.
Super interesting. Thank you for sharing your thoughts.
So why might Europe be in the pickle it's in? I mean, not to belabor this point, because people who follow me on Twitter or listen to my podcast or what have you know, I'm tilting at windmills here a little bit, but I think it's important to recognize that Europeans' failed green energy policy was a mistake, and it was obvious to observers such as myself before Vladimir Putin invaded Ukraine on February 24th, I believe, of this year. And you'll notice in this chart on the left-hand side, we have natural gas prices. And this is natural gas prices per megawatt hour in US dollar terms. And you can see right here, roughly, is where Vladimir Putin invaded. And you can see the spike happens basically the week or the day or whatever after he invaded. But as you can notice, before that, you could see that the price of natural gas was probably 8 to 10, depending on the day you choose, what have you, X the price of United States. So in the United States is the green line. The Henry Hub is the name of a particular hub in the United States. I can't remember where it is. I think it might be in Texas or Oklahoma, what have you. And the reason I bring this up is because Europe, for all the criticism that it has got in the financial market circles for a long time, was actually sort of had its stuff together. Let's say current account balance, its trade balance. For one of Europe's, usually the bête noire is the Italy, is always the one that gets is always lagging in productivity or in industrial production. But the chart on the top right hand side here shows you that the trade balance was actually quite strong, meaning it was starting to there was internal devaluation, the economy was starting to improve, and then not only improve but sort of compounding subsequent improvements together. And it was stringing a couple of wins together, so to speak. Europe's insistence to close down the other three perfectly working nuclear power plants on the sort of the green dogma that nuclear power wasn't real. And so why am I bringing this up? Because they've set themselves up for basically failure. There's a great quote from Mike Tyson, and everyone has a plan until they get punched in the mouth. And I think that this naivete on the geopolitical space and the usefulness of crude oil allowed for any kind of mishap, whether it's their fault or otherwise, to massively affect their economic situation in a profoundly negative way. Italy is one of the most indebted nations in the world. They need a positive current account balance for money to flow in order to meet the debt obligations that country, the private and public sector, have. For this blue line, this trade balance, to collapse with such rapidity and depth is a profoundly dislocating thing for an economy, which again is on tenterhooks to begin with. And that, I assure you, is a function of, in my view, short-sighted and quite naive energy policy. Why is it naive? Because fossil fuels are not going anywhere. What's going on in Europe, and I'll spend a lot of time there because obviously you guys have clients, and I think it's going to affect the global credit market, equity market, interest rate policy. It's going to affect, so it's affecting what's going on in the UK, et cetera, et cetera. This is a key pivot point in the global economy right now. And although maybe it's, some might be surprised that how much emphasis I put on this. This is something that is acute, is sort of was foreseen, but also there is an exit. There is there is an off ramp, and I think that's why it's a tantalizing subject to discuss right now. Fossil fuels are not going anywhere. So global fuel consumption is about 90 odd million barrels of oil per day. Each barrel of oil is about 42 gallons. So 42 gallons times 4. I'm not good at arithmetic. You guys can do the math, but it is an incredible amount of oil that is consumed every single day. On the right-hand side, we have fossil fuel supply, 83% of the world's energy. You'll notice this tiny little bar over here is renewables ex hydro. So, and then obviously you have nuclear power. And so this idea that human beings are going to pivot in the matter of, let's say, I don't know, I've seen net zero calls of 10 years, the abandonment of fossil fuels, whether it's natural gas terminals, whether it's not, expanding, fracking, or whether it's banning pipelines or anything like that, is, in my view, a profound dislocation from reality. Human beings rely on fossil fuels to maintain their standard of living absolutely everywhere. Even countries that have contracted their emissions, such as the United States, by 20% since 2005, still profoundly rely on on fossil fuels in many industrial applications, and transit and transportation of virtually every single thing that you do and use. And so this idea that human beings, and our civilization, as we understand it, can simply just shift away from this without an intense amount of investment into a much more, in my view, suitable energy producer, nuclear or hydro, or B, incredible amount of pain, is not a fair assessment of the cold hard facts. So the next slide, I think, is also really important, and it'll sort of end our section on energy. But maybe there was one more. But it's about why I think energy prices are going to stay high for a long time. It also speaks again to the naivete of the European energy policy, and as a function, the consequences that sort of every other human on the planet, businesses, consumers, will face as a direct function of this. Make no mistake, I'm not underselling the importance of a particular dictator invading a independent nation, but it's energy policy should focus on reliability, robustness, and of course, in my view, allow for things to go badly. And I think that's sort of naivete that many people smarter than myself have warned about for years was soundly ignored and even mocked to some degree. On the bottom left of this chart on the left-hand side here is consumption and production of crude oil. Now you'll notice who's at the top: Russia. This yellow line this yellow diamond, is the net production of crude oil. So you have what you consume minus what what you produce minus what you consume gets your little line. And there's a couple of countries that stand out here. Canada, that is dead set against producing crude oil and fossil fuels. Is actually one of the main beneficiaries of this and would not be able to fund its very, very generous welfare state without oil. We've got other countries like Norway, who of course have turned their back on oil now, but have spent the last 25 years building a sovereign wealth fund that owns 1% of the S&P 500. We've also got the UK here, which, is in the news these past couple of days, but is relatively balanced. And then at the bottom, you have China and the European Union. The European Union, which consumes an incredible amount of fossil fuels and produces none. This is purely a policy decision. 15 or 20 years ago, European Union produced as much, if not more, natural gas as Russia. Now they're completely beholden to Russia with respect to natural gas. China, which just simply does not have the resources to exploit, is still one of the largest producers of crude oil in the world, but consumes an incredible amount of oil and will continue to consume an incredible amount of oil. This red line over here on the right-hand side is consumption and is on an basically, in my view, an increasing trajectory. The second largest populace in the world is India, and again, same thing. These are billions of consumers that have just been introduced to automobiles, TVs in some cases. In India, I would argue maybe even air conditioning. And that takes energy, and that energy must come from somewhere. It is not going to come from renewables, in my view. I think that that's a particularly naive view. I think the only way to really deal with that is going to be nuclear or hydro, or making existing fossil fuel plants much more efficient, ideally shifting to natural gas. But again, I reiterate this point because on the next chart, you have why prices will remain high. And this is, again, back to why we're here to talk today, which is about what CFOs will deal with, what businesses are going to have to face in the future, why, and if it will change. So, there's in economics 101, you learn that, for some many commodity or businesses that have self-fungible or interchangeable or, like commodities businesses where, these products are virtually the same. More or less, a barrel of oil from Saudi is the same as a barrel of oil from the US. I understand that there's some sulfur issues and one has a slightly different gravity or consistency or viscosity. But, for the purposes of this discussion, they're basically the same. And, in aggregate and over time, commodity businesses should not really make that much money. The marginal cost should equal the marginal revenue over time, and there should not be a producer surplus, just like there should not be a consumer surplus. The supply and demand curves should basically meet, and over time you have a situation where there's just really horse trading, but no rents should be extracted. Rents in the form of excess earnings over a significant period of time. The reason that prices are high, and in my view will remain high, is because of the lack of investment in this industry. Whether it's because pension funds have insisted on divesting in this particular industry, whether people have poo-pooed the idea that countries should have their own or independent or energy market, or not have energy LNG terminals like in Germany or what have you. And so what this chart shows you on the left-hand side is CapEx, which is capital expenditure to total assets, and then the price of oil. And normally, this is a really interesting chart because as the price of oil, as the price of the commodity that is being sold accelerates and gets higher and higher, the CEOs who run these businesses can't help themselves but invest every marginal dollar into CapEx in order to extract as much money as they can in the shortest period of time. And now that's not necessarily a great idea, but let me assure you, as the sun rises and sets, that is what the CEOs of these businesses do. And normally you get a situation where the CEOs are always chasing that extra marginal revenue. And what it does is it increases production, which, increases supply, and then the price falls. And then, you get this boom bust cycle and everyone gets wiped out, but the prices stay relatively stable. Now you're in a situation where for the last, 10 or 15 years, you've had the CapEx basically not increase at all. In certain countries, like in Canada, the CapEx for that sector is at a 25 or 30-year low. And so these companies that have basically had their capital expenditure decisions basically taken away from them are making money hand over fist as a function of these, in my view, short-sighted policies. And so, and also as a function of that is you'll see that the prices will remain high because, as I've demonstrated, demand for the product is not going anywhere. So where does that bring us? That brings us to a similar story for green energy technology. So green energy is absolutely, probably the future. I think it's just going to take a lot longer than people expect. And I think that people should start including things like nuclear power in as far as green energy. But the problem with lots of the other, the current renewable energies that we discuss is the degree to which they how much other materials that they take in order to produce. So whether it's, power generation, offshore wind, you got solar, photovoltaic cells, and you've got, onshore wind, whatever it is, it takes an incredible amount of, whether it's copper, cement, rare earth metals, et cetera, et cetera. Unfortunately, there has this, you'll notice this chart is the same. Unfortunately, there's been a similar underinvestment in the infrastructure and operational ability to extract the minerals required to build these green energy technologies. So you're in a situation where, you've got the existing, sort of what we've relied on forever, which is the fossil fuels, those prices that, that might affect inflation. But in general, I think that this is going to prop up prices for a while. Another thing so that's sort of the section on energy done. We've also going to talk about sort of margins, and we're going to talk about wages. So these are all sort of the trifecta of sort of macro pressures that businesses all over the world are sort of feeling. We've got sort of the policy pressures, which is, the fallout from Europe's energy policy decisions, COVID zero in China, the Federal Reserve raising interest rates. And then we've sort of got sort of the closer to the boots on the ground issue, which is like the macro drivers that are affecting, that are sort of endogenous, that are sort of outside of the hands of the policy makers and the policy levers. One of them is sort of the fallout of the energy issue, which is the lack of capex in key industries. Ergo, the prices will remain high. The second is what I expect is sort of a mean reversion in margins. And then the third bit is as to why. So this is a chart of profit margins for the equity market. I've used two sources here to sort of, cross-check my work and make sure, just to keep me honest. The reason why the red line is much, much lower is just a function of index construction, as well as, one is smooth. And it also, I know that the MSCI excludes negative earning companies for some reason. Anyways, don't worry about that. But the point is just the real issue here is that we're basically at an all-time high in profit margins. And not to say that mean reversion is a solid or sustainable investment thesis, but it is important to note that it's very, very difficult for margins to stay this high. As you can see, they're often quite cyclical. We had 2008, when there's a recession, it falls, and when there's growth, it rises. And we're in a situation where we're at a high in the profit margins. And so why might the margins go ahead?
Sorry, Richard, just on this, because you mentioned that the record profit margins are currently coming under pressure. So I'm certain this is top of mind for a number of the different participants that we have. So given all of this, what should business leaders, start to think about? Do you see we're going to see more of the same as we go forward? And what are some strategies that they might be able to take to be able to mitigate against some of this risk?
That's a very, very difficult question. I don't know what individual businesses can mitigate. I think maybe the next section will sort of help me explain where they can maybe not feel the squeeze as much. I'm not sure if they can protect their margins in an environment of higher input costs, slower growth, and higher labor costs. I think that however, I think, Kolleno offers a service that improves, the cash conversion rate. That's another way of dealing with, you might not be able to improve or defend your margins, but you might be able to get paid quicker. And then that's one way to deal with it. I think the next section I'm going to talk about is the labor market and the stresses that companies might have to deal with that. And maybe a way of dealing with or protecting your margins is, finding the right staff. And then, but again, that's out of my lane. I'm not an entrepreneur. I wouldn't call myself an entrepreneur, but that's the best I can offer, I'm afraid. Mm-hmm. That's an excellent question. I'm sorry I couldn't give you a better answer.
No, that's great. And I know we're going to be talking about some of these things as we go forward. So
okay, cool. So just interested in time, I'm going to skip this one. So we talked about. I just quickly said, I talked about the pressure that that businesses might face On the top line growth, this chart's a really good one. Again, I'm not a super big fan of models. I think people get married to the models, but this is sort of a way of just framing the discussion, and then sort of, you set it up, and then you move away from it or dovetail off it or what have you. And on the right, this red line is a chart, or is a piece of data that I think all businesses all over the world should be intimate with or understand. And this is the ISM manufacturing PMI. ISM is a nonprofit, quasi nonprofit out of Arizona, and they have been asking thousands and thousands of companies for the global sales growth of every single listed equity market in the world. And you can see what we're the situation we're dealing with right now. It shows you, the global sales growth cycle has peaked. Now it's peaked at quite the high number. Some companies have had absolutely fantastic, couple of years, but we're starting to see that as the cycle slows, sales growth will likely slow with it. So again, back to this profit margin, you've got high energy costs, you got slowing sales, we got slowing sales. What about the labor costs? So input costs come in different ways. Obviously, there's materials, there's different commodities. You can think about the lights, you can think about the gas, you can think about the physical tangible input costs that you might put into a widget or what have you. But then there's also labor costs. I'm sure many of the companies that you guys work with, labor costs are a large part of a large chunk of their cost of goods sold in one way or another. And I think one of the fascinating wrinkles of the last couple of years is that I think wage growth is actually going to stay elevated. People say, Richard, if you're predicting sort of, if not a recession, a mid-cycle slowdown or weaker sales growth, isn't it contradictory that you think wage growth will remain elevated? And I think that they will remain elevated because we're dealing with a generational inflection point. Now, this chart's a really fascinating chart. If you have to take away one chart from one chart from my presentation today, I'd probably go with the energy chart. But the second one would be the fact that the age dependency ratio is rising for the OECD. I've put the US there because the US has just got great data, and so it's obviously one of the largest economies in the world. But the age dependency ratio, I always screw this up, so forgive me. It's the ratio of people that are younger than 15 and older than 64 relative to the prime aged workers. So that's all the people in between. I always get confused about which one's on top, which one's the numerator, and which one's the denominator. But basically, you get the idea. As this series starts to rise, you have fewer and fewer working age people as a percentage of total. Now, this is the first time that this series rising in earnest, not a blip, but in earnest, is the first time that this has happened since 1962, I believe, is the peak, or 3. And what this means is that there's going to be a shift away from capital towards labor. So what do I mean by this? Meaning there's if you want to, to quote Karl Marx, there's a battle between capital owners and labor, and they're constantly in the struggle for who gets more of the pie, the GDP pie, the profits, the surpluses, etc. And if you have much more, if you have way more laborers, then obviously the supply goes up, and the price, so-called, quote unquote, their wages, if you think about this from like a theoretical philosophical point of view, will be depressed. Well, the opposite's happening now. You have less and less workers, meaning the supply of those workers is going down. The demand, for those workers, let's say, for argument's sake, is relatively constant, meaning the price of that labor, that marginal labor, is starting to go up. And we can see, we can sort of see that what's happening again in the US as an example. So here on the left-hand side, we have, the NFIB survey, which is the National Federation of Independent Businesses. Again, this is another survey data, so you have to take it with a grain of salt. But I think the other pieces of, evidence sort of help, basically help us, corroborate what's going on. And again, there is just a supply mismatch and a labor shortages across the economy. And that's why I think, wages will stay high, whether it's because of, a misallocation of resources with respect to university degrees or age. You think of all there's anecdotal evidence of people who run skilled trades where there are not enough bricklayers or electricians they're all too old, and they're all retiring in the next couple of years. And as a function of that, you have a higher input costs. And then we talked about inflation, but I think we're running a little bit on time, so I want to leave some time for you guys to have any other questions. And is that okay? So that's sort of the world we're living on. I know it's not such a rosy picture. I think in some ways it might be good. I mean, if you're a vendor that sells to people who might otherwise be having increased wage growth, I mean, I think you're in a really great position. I think if you're an energy business, I think you're going to be making lots of money for a long time. But I think if you're a business that's operationally levered to those other two, I think you might be in some trouble. But Gibran, if that's okay, I'm going to end it there.
Yeah,
and leave it open for questions.
That's great. Thank you so much. Thank you so much, Richard. There's a variety of points that we'd certainly be interested in deep diving on. But what I will do at this point is invite any of our attendees. We have our chat open, so please feel free to throw in some questions, and I can help moderate that as we go forward. But just as we wait for some questions to come in, just a few questions top of mind here, Richard. So, you talked about, a number of the different elements, a number of the different circumstances that we currently face. You talked about, inflation, energy, and some of the issues we're seeing on the global supply chain. I think we all wish we had a bit of a crystal ball, and I know that's not possible. But, in your view, what do you see kind of going forward? What do you think is going to be the likely kind of outcome, or some of the key factors that we should be watching out for as we go forward?
Well, I think that there's the one good thing I think of slowing growth is that I think there's slowing demand. And I think a lot of the pressures that have been put on the supply chain have been from outsized demand due to stimulus, both central bank and government stimulus. So there's three things now we're seeing. One is the central banks are removing that stimulus. Two is that governments, well, who knows if it's going to happen or not, but they are claiming to want to take away their portion of the stimulus. And to be fair, in some cases, they already have. And then the third bit, which is sort of the natural ebb and flow of the cycle. And as I showed you with the ISM PMI chart, we're already starting to see that demand is at least, if not slowing, certainly the peak of it is behind. And so with those three elements, I think that the demand part of that supply chain issue is definitely going to be alleviated. We're also starting to see evidence of that in other ways. So one of the big headlines over the last couple of years was that shipping costs, for example, exploded, in some cases going up 5, 6, 7 times what they were in 2018 and 2019. The opposite is now true. There's a series that I don't have in this presentation, but you'll have to take my word for it. It's called the Shanghai Shipping Index. Shanghai and much of that part of China is obviously very important for the global economy and trade and exporting and what have you. China has an enormous merchant fleet, and the prices to ship goods from Shanghai or other parts of southeastern China to, let's say, California or what have you, are now collapsing. So that's an indication that the supply chain issues might be, in some cases, being alleviated. Another sort of more sort of corroborating evidence is literally just asking these companies if the backlogs for certain goods are going up or down. And again, we're seeing it all over the world, whether it's the US, again, referencing the ISM manufacturing index, you can see the backlogs or inputs of commodities issues, whether it's Germany, they have a company, it's a non-governmental organization called the IFO, which is, very reputable source for this kind of data. They literally ask these, whether it's a construction company or manufacturing company, automotive company, is it harder or easier to source parts, et cetera. And you're seeing that all those sort of indicators are coming off. So I think that's very much a sort of a problem that's in our rear view mirror and not what I think is going to be happening going forward.
And so I see a number of different questions that are coming in from our audience. I think, first we'll start with a kind of more broader question around peak inflation. So we've seen, a number of different reactions in the UK, in the US, and Canada from central banks trying to tame this. So wanted to get your perspective in terms of, where we stand with some of those policies, where we see kind of inflation going, and do we think we've hit the peak for that?
So yeah, so inflation is absolutely one of my favorite topics. I think it's. I just like to remind everybody how all the central bankers said that inflation was going to be transitory, and how much of a farce that comment was by them. So I think inflation has peaked. I think inflation is just simply a rate of change over an index. So you have, if you think about what inflation is, you have a consumer basket, or in some cases a producer's basket, which is known as the producer price index, but it's basically a basket of goods. And then you just calculate the rate of change year on year, or month on month, but year on year. And that year on year number is what we understand as inflation. So the chart that I'm showing you here is the US headline inflation number year on year. And as you can see, it has peaked. Now, it's peaked for a couple of reasons. One, because energy, which is a large component of this basket, has come off. As we know, crude oil prices at one point were $120 a barrel, and now they're, I guess 85 or 88 or whatever it is. So that's come off, and that's pulled down gasoline prices. And obviously, that is, the knock-on effect of that is to be a drag on the headline inflation. Headline, by the way, for people who may not know, is all of the CPI the consumer basket. Underneath that, you might have something called core. Now you remove energy and food. Now, whether or not the wisdom of doing that is a conversation for a different day, but that's what happens. And that's volatile components. I think it'll keep it elevated. Now, do I think that we're going to get much higher? No, I don't think so. Because again, a lot of this has to do with math. It's very, very difficult for your year-on-year number to continue to rise. And I guess math is a boring answer, but these base effects are meaningful. And, unless you have a country that's completely, run badly, like Argentina or Zimbabwe or even the UK, that's a joke. You will not get inflation that continuously goes into the stratosphere. It's very, very difficult, just purely from a math perspective, for it to go higher. That, back to our conversation about supply chains and those kinds of things, sort of that impulse sort of dying. However, in the US, shelter is a very, very important contributor to core inflation. As you can see, the shelter component continues to rise and continues to put pressure on that core inflation number. That's what this chart is. These bars are sort of the contribution, and the shelter component over here is that red line. And so, again, a long answer to a short question, but I think it's really important to understand when we mean peak inflation, what do we mean? We just mean that prices will rise, but at a slower rate than they have been in the past. How do businesses deal with that? I guess that's, for you and for you, Gibran and Dimitri, to help with as best they can. I guess pushing prices through. I mean, I'm going to get in trouble. I'm going to get out of my lane here.
I think, very much linked to that, this is a follow-up question. Their operations and also for growth. But, one of the questions that we do have is, given the inflation, what is the best asset class to invest in at the moment? And is gold still a safe haven?
I mean, so I think gold. So let me answer the other way around. So gold, in my view, is at the mercy of real interest rates. So there's something called a convenience yield, which you learn in your second or third year of finance, which I am now going to completely butcher. But the point is if it's basically, it's basically over the last 15 or 20 years, you've seen a very tight correlation between the inverse cost of money and gold prices. So when the money becomes less and less and less expensive, gold tends to go up in value because it doesn't cost money to borrow and hold it. And when it starts to cost something, meaning you have an alternative, a substitute, then gold tends to decline. And so that's what we've started to see today, recently. I think gold remains vulnerable because real interest rates are rising. That is the express and stated goal of the Central Bank of the United States, which again is the only one that matters, I'm afraid. And so for me, gold is not as attractive as it might otherwise be, in an inflationary environment. The relationship between treasuries and equities is a great question. And you're right, whoever asked that question. I think in the past, that relationship is negative. I remember, again, harking back to my CFA days, you're supposed to buy assets that are not correlated and, to improve or reduce the volatility of your portfolio's returns. But over the last, 6, maybe even 10 months, bonds and stocks have been moving lockstep with one another. I've gone on record many times as saying it was not equities that were the bubble, it was bonds that were the bubble. I think I'm being proven right as we speak. Everybody, I don't think I think if we have if I'm wrong and inflation hasn't peaked, I think it's going to be, I think those correlations will continue to remain high, and I think it'll be very difficult situation.
Well, that's fantastic. I know it's certainly a challenging time, both for investors and business leaders alike. But certainly do appreciate your time, Richard, and your perspectives here. Certainly think this is helpful for for our audience, and especially CFOs and business leaders and investors as they start to think and plan as they move forward. So really do appreciate your time here, Richard, and to the audience members. Thank you all for joining us today. We will also be sharing a recording and a copy of the slides as well following the event. So thank you all, and Richard and Dimitri, thank you both.